In market news, the Fed announced they are increasing the basis rate 0.5%. This is the largest increase that the Fed has done in one fell swoop in 20 years, I think. Now, our historical rates are actually still very low. They're actually significantly low. In fact, I'll bring up historical. You can just Google historical mortgage rates. It's a recent search of mine. So let's do, boom, let's do this. Let's do Freddie Mac. Okay, someone give me a graph. This is lame. I'll share my screen with you and show you what I'm looking at. Historical mortgage rates. Yeah, I think this one was helpful, the St. Louis Fed. Here we go. So check this out. Since, what is that, 1970? These are the mortgage rates. This is us right now. This is, I want to say this reflects, or at least you can see its trending direction, right? But still, we're at about the same rate as we were in 2010, right? So that's historically, that's actually still pretty low. So that's something to consider. But I would, something to comment on that, even though they're increasing, and the reason that the Fed's doing it is, they want to hedge off inflation. They want to address inflation, help slow it, which is good for the economy. A lower inflation, closer to 2, is way more healthy for an economy. And we're up at 8.5 now, which is still, the largest or the highest that it's been in 40 plus years. I read recently, of all the money that's ever been printed by the United States, 40% of it was printed within the last 18 months. So that's just going to happen. Inflation, that's just going to happen. So that's something to say. But with interest rates going up, this should cause us to adjust our strategy. Not our overall strategy, like, oh, maybe I should switch from Burr to wholesaling or something like that. Because that, you still need something that generates passive income. But when our initial kind of default is, I want something $400 a month, $300 a month, right? That is something that we're going to need to check, right? We're going to need to adjust that a little bit, because right now, the value of, let's say 2 or 3 years ago, the value of getting a cash flowing house was primarily in how much money you could get in your pocket that month. Appreciation, not really as big a deal. Tax hedge, still great, but not the prime motivator. But prices were relatively cheap, and if you could find them, money was very, very cheap, right? So you could get a lot of money in your pocket. That's great. Scaling is great, perfect. It made it easier in some capacities. Now, on the other side, now there's less money that you'll be able to make per month, right? And we're not talking about going from $400 a month to $3 a month. We're talking about going from $400 a month to $250 or $300 a month, right? I'd say about $100 change just because of the mortgage rate. All right, so there's less money in your pocket, but the appreciation value of that money goes way up because inflation is at a 40, 50-year high. All right, so if you look down the road, if the market's going to increase 10% by the end of the year, which very well might happen, in the next 6 months, if you get a $100,000 house right now and your money's at least in the market and you've got that, it might increase to be $110,000 of value, right? And if you put in a turnkey, you bought it for $20,000 down, you just made 50% of your money, right? So then down the road, everything else is just on top of that, right? So that's how I'm adjusting it. I'm expecting to make less cash flow. And if my cash on cash return dips a little bit, that's okay, as long as I have a reasonable confidence that the value of that property is going to continue going up, right? And for most properties, that is going to be the case. And so that's how I am adjusting my strategy. And this is always, we want comfort, right? We want something that's unknown. But the beauty of the market is it's dynamic, right? So it changes, right? I think about, when let's say you're playing a board game. I've been really into games like Settlers of Catan lately, and you place your first piece, and then you're saying, okay, I'm going to go there with my second piece, and then someone places there, right? You got to completely on the fly adjust your game plan. It's the same thing like, Muhammad Ali, I think, said everybody's got a plan to get until they get punched in the mouth, right? You've got to be able to adjust. And so this is what we need to do. You need to be able to adjust and say, okay, if my priorities are still this and my goals are still this, right? Look at my goals and let that inform my strategy. And we're looking through the lens of our constraints, your constraints being time, mental and emotional capacity, finances, capital, right? So that should influence how you look at things. And for me, the way that the Fed announcement has adjusted my expectations is I'm going to get higher rates. That's just going to happen. It's going to chew into my cash flow. That's just going to happen. But if I can get it on a fixed mortgage, right, a fixed rate, I'm going to pay a little bit more for that, but it protects me down the road, right? But if I can just get it right now and let it float in a year, it's going to cash flow 10% more, right? Because if let's say I've got a quadplex that brings in $1,200 a month cash flow, bottom line. In a year, that's probably going to be $2,400 a month, just because my top line rent is going to increase. So that's some guidance that I would give you, just relative to the market and what's happening in the market.